Hey guys, welcome back. Episode 2 of Be A Clever Homeowner with myself, Dave, 26 years in banking, and your superstar agent right here.
Right here, Melvin.
Melvin Ortiz. Hoping that subscriber count goes up once you guys realize that we do got some valuable information that's specifically based for buyers, investors,
Yes.
all that kind of good stuff. So we're going to dig into some amazing information for you. And, we're going to talk about...
Today we're going to talk about the most common loans, right? The best loans available right now. But before we get started, I got a little nugget for you.
Give it to me.
So, everybody knows Johnny Walker, right? And we're going to be sipping on Johnny Walker Green Label today.
Gotta make sure to give you the information before we sip.
So before, I found out a little something about Johnny Walker. Get this. Did you know, Dave, that Johnny Walker was established as a grocery store?
No way.
Before they started distilling whiskey.
Wow, that's crazy.
Right? So 1820? Was it 1820?
Yeah, I think that's what it says. Established in 1820.
They were a grocery store before they actually started distilling alcohol. That's amazing. So
that's crazy. Get a little 14, 15-year-old kid distilling his whiskey, and now it's one of the most established brands that are out there.
All right, so let's get started. Ooh, that smells amazing.
That is nice.
Ooh. So this is the first time that I have Green Label. I had Blue Label before, and I think everybody's had Black Label, right? That's like the most common one.
Yeah.
This is Dave's bottle today, so let's see. I'll give you my opinion on it.
All right, let me know.
So you get started with the best loans. Let's get started.
So guys, there's basically 3 of the most popular types that we're going to get into, and that's going to be VA lending, FHA mortgages, and conventional loans. Biggest differentiator between the 3, right? I'll just start with VA loans. VA loans are incredible if you're a veteran. If you're a veteran, differences between that loan is that you can't have any co-borrowers on the loan with you unless it's your spouse or another veteran. But the beautiful thing with VA loans is it's 100% financing.
Yes.
And the way that works is you talk to your banker, we get you what's called your certificate of eligibility. And the way that certificate of eligibility basically works, depending on the county that you're purchasing in, there's going to be a max loan limit for that county. And easiest way to understand how a VA loan is like FHA loans, they have mortgage insurance. Conventional loans with less than 20% down, they got mortgage insurance. But the VA comes out and says, look, you serve this country, and something we want to do back for you with this VA loan product is when you go to buy your home, 0% down, but you don't have mortgage insurance, rates are extremely aggressive. And the reason being is because the VA, they basically guarantee up to 25% of that purchase price. So depending on the county that you're in, let's say you're looking at a house and it's $600,000. Your loan is going to be for that $600,000, but the VA is actually telling the banks, look, if something happens to this client or this borrower, and you have to take a loss on this or foreclose, God forbid, on this property, you are insured up to 25% of that value, which is incredible because, again, for a buyer, that means you're buying a house with nothing out of pocket, but you get the benefit of having like 25% down payment as far as the rate and having no mortgage insurance and all that stuff. Incredible process, incredible product, and we've helped hundreds of veterans with that. Another awesome thing.
Quick
doesn't
question,
matter.
Dave. So what else does the VA loan cover for the buyer? Is there anything else that covers in that?
A couple amazing products that the VA does have. Let's say you're a veteran and you were disabled. You can get up to $75,000 to make upgrades and modifications to a house to make it more friendly for that veteran.
Nice.
Another incredible thing is that VA loans don't necessarily have income limits or debt ratio qualifications that other loans have. It's more based on your residual income. So I've had veterans that were told by 20 other people, oh, I don't qualify for this property, blah, blah, blah. And when I run the numbers, we're able to make things work. So it's an amazing product. And for our veterans out there, we take excellent care of them. Another cool thing is a lot of people think that if like you're a vet and you're buying a condo and that condo isn't HOA approved, you come talk to me. Mel, do we have a problem getting HOAs approved for VA lenders?
Never.
We just got one done for one of our clients. Loved the property, went through, slammed that thing out. 15 days into the process, HOA was taken care of through the VA.
Now it's good to notice, right? To note that it does take a little bit longer, right, to get it approved.
15 business days is what the VA says. Sometimes you can push, but you just got to make that a point up front and let all the parties involved know, hey guys, we're starting the loan process. It doesn't hold anything up. It just means on day one, Melvin and myself, we're on top of it. We're talking with the listing agents. We're talking with escrow. We're getting the docs we need so we can get that stuff over to the VA and we can make sure that we get that property sold.
Yeah, and what that means for you as the buyer is that our team will guide you through that process, meaning so you know exactly when your move-in date would be, right? So that means that if we are set for a 21-day escrow, which that's what we usually do for these types of loans, and it does get delayed a little bit, maybe we'll move into a 32-day escrow or something like that. But you will be updated constantly on where that process is.
But more importantly, if you're a VA buyer and you got the right team and you're looking at a condo, right? You don't have to look at the list and go, hey, there's 72,000 HOAs in California and only 110 are on the VA's approved condo list.
Yeah.
That basically means Mel can show you properties anywhere and you don't got to worry if it's approved or not because we take care of all that stuff for you. So VA loans, they're incredible. Loan number 2, but before we get into loan number 2, we're going to talk about FHA. Let's take a taste.
Oh, yeah, let's
Let
do
that thing set on the palate.
Yes.
And before we get into conventional, let's
smells amazing.
Let's give our a review, but you got to let that palate sit for a little bit. So let's try it first.
Okay.
Cheers.
Salud.
Cheers, everybody out there. Smell is good. It's very smoky.
Very smoky.
Very smoky.
But very well balanced, though.
Absolutely.
I would say it's not as smooth as Blue Label.
No.
Right? It has more bite.
More bite.
Yeah. Especially in the beginning.
A little more smoky on the after.
Yeah.
The aftertaste in your mouth, you almost could smell like you took a puff of a cigar. So.
Yeah. And I mean, I think that's the nature of whiskey and scotch, right?
Yeah, absolutely.
Where compared to bourbon, and we can talk about this later, right? Compared to bourbon being American, right? We have more flowers and little and fruits and stuff around where the liquor is being distilled, so it's taking all those floral notes and stuff like that. Versus in Scotland and in Ireland, where it's just not a they
and
don't
the
have
barrels,
access
right? They got smoky fire burn barrels. You're gonna get that.
Well,
smokiness
that's how they give it flavor, right? Instead of having the flowers and the fruits around, they give it flavor with the barrels, right?
And you would think maybe if we had some, maybe it's too soon to say the joke, but I guess if you had some distilleries, by the fires, maybe we'd get a better flavor.
Oh, man, Dan. Too soon. All right.
So next type of loan, guys, FHA. Big thing, cool thing about FHA loans is 3.5% down's a minimum payment. That 3.5% can come from a gifter, come from a family member, comes from a friend. It just basically is money that's given to you that doesn't require being paid back. And again, the minimum out of pocket on a VA loan is the bank says, look, whatever that purchase price is, your minimum contribution to this transaction is that 3.5%. FHA loans in the past used to be looked at as, if you had bad credit or, if you maybe shouldn't buy, but you really want to buy, use an FHA loan. The reality today is that FHA loans, the pricing is really, really aggressive. If you put down 10% or less, your mortgage insurance is going to be on that loan forever. If you put down more than 10%, that mortgage insurance is going to be on that loan for the first 10 years. So first payment on year 11, that mortgage insurance would fall off if, again, you put at least 10% down. The cool thing with FHA loans, VA is a little similar, but with FHA loans, an amazing thing going on right now with some of our banks is you don't have any LLPAs, which is called lender price, loan level pricing adjustments. And what that means is sometimes they'll say, oh, well, if your FICO's 640 to 659, here's your rate. And if your FICO's 660 to 679, here's your rate. The beautiful thing right now, and we like to, when we have these pre-approval processes and consultations, one thing that we like to teach our clients too, right, is there's a lot of shady stuff, or not shady, but a standard business practice, right, is, lower credit scores means higher rates, right? And sometimes that doesn't really translate to what's true and realistic. It could just be someone who's selling you on the idea that because you got a 670 credit score, your loan's not going to be as good as someone with an 800. And I can tell you right now with FHA products, 660 to an 800 credit score, you can get the exact same loan or the exact same rate. And I've had people come in that are like, oh, Dave, I want to buy, but I need to pay these two things off to get my FICOs over 700. And
Dave, I got a feeling that a lot of lenders are going to be mad at you for saying that.
that's all right. Lenders are mad at me now because I full disclose, I teach people what lenders, sometimes do that they shouldn't. And again, Clever Homeowner, the whole purpose of this channel, guys, is to share this information with you so that you are aware of what's out there. So, a question you could ask someone if you're buying a house FHA is to go, hey, what's the difference between a 680 FICO and an 800? What's the pricing difference? And you talk to them and maybe call around, not just me, but call other people, talk to someone and see if you can't find someone that says, oh, actually, you know what? There is no difference. Rate's the same. Cool. That's someone that's giving me accurate info. Not all banks, but again, that's why it's important to know who has certain products.
Quick question. So how does the rate get determined then?
The rate's just determined, there's an initial pricing parameter. So with certain banks, just like when FICOs hit a certain cap, they may say, hey, once your FICO hits 740, there's no more benefit. There's no pricing incentives once your FICOs. Just like when you go buy a car, right? And Honda says, look, as long as you got a 680, you're tier one. I mean,
It's
the same thing. But that's why it's important to know banks and have multiple products.
So it's set pricing, basically.
Set pricing. Okay. The banks have set pricing. I'm going to get into a little bit and give you guys another nugget when it comes to rates. But everyone's base rate, you can have 20 brokers all working with the same big bank, and the base rate is all the same. The pricing difference that you may see is going to be based on what that broker's commission structure is, which makes a big change, and I'll give you guys a little nugget. But yeah, just know FHA, that's a great thing. Another cool thing is their mortgage insurance premium is fixed. So that means if you're buying a standard home, it's not a jumbo or a high balance loan, it's a 0.5% of the loan amount. So whether your FICO's 800 or your FICO's 600, that mortgage insurance premium is based on the same percentage, which is awesome. So if you're thinking, man, I got a 660, I really want to buy a house, I have 3.5%, but my mortgage insurance is going to be higher and I'm going to take a rate hit because of my FICO scores, may not necessarily be true, guys. Okay. You need to do your homework. And the third loan is conventional.
Your conventional loan. Well, I wanted to say something a little bit about the FHA loan on my side and why I love it so much. And I think I just hit the mic there, so excuse me there. So what I love about the FHA, right, is that it also allows you to buy units at a higher price range.
Absolutely.
For low percentage of down payment, meaning that you can buy a duplex. What is it now? They keep raising it up to 1.25 mil.
Yeah, it's up there.
1.25 mil duplex with just 3.5% down.
Absolutely.
Right? That means that you're able to get into a way bigger, nicer property, right? And have a tenant pay for part of your mortgage, and therefore your monthly payment gets reduced to the price of a smaller property in a sense, right?
Absolutely.
And now you can, let's just say down the line, 5, 6, 7 years down the line, whenever you want, right? You can refinance into a conventional, drop that, or even keep it as an FHA, right?
Absolutely.
And then you can go buy another property at the same time, right? Meaning that now it allows you to get into basically what it comes down to, an investment property first, and then move into your big, nice, comfortable first-time home, long-time property for your family, right?
Yeah, the main thing
is it gives you flexibility, and that's what I like about it. We have done this with so many clients in the past.
And with that loan, right, what we're talking about, it's not that you're coming into this at all with the intention of investments, but what it allows people to do is, let's just say for people that are local to us, like say parts of Southern California, let's say that your price point is $700,000, right? But you can buy, say, a 2-unit property, and we can use 75% of the future rents from that second unit as income to help you qualify. Now, the nice thing is that may allow you to say, hey, you know what? Or maybe you're like, look, Dave, I'm not comfortable paying, $4,000 a month. And this 2-unit property, let's just say that it's $1,600 or $2,000 more. But now because you have a tenant who's maybe going to start paying you $2,700 a month on that second unit, it allows you to qualify so you can get in the area that you love. You know, you can get in your home, you can establish yourself in that area, you can put your kids in the school district that you want. All these things that allow you to start building your life in this area that maybe you weren't able to do before. And then, you know, as time progresses, maybe a couple years go by and you say, you know what, my income's better. You know, I got some more money saved. I think now we're really interested in buying a single family home, right? And we can look into those options for you. But 100% it allows people to come in and you get the benefit of saying, hey, I have a home, but now I have a tenant, you know.
Yeah.
And there's
and also the multi-generational family situation too. I mean, in our communities, right, we most of the times we don't like to put, it's not our culture to put our, you know, grandma and grandfather, you know, in a nursing home.
Absolutely.
Or assisted living, right? We in our culture, we keep them close to the family, right? So now you can buy a duplex, a triplex, right?
Yeah.
Or 4-unit property with an FHA,
Absolutely.
right? Duplex, 1.25, right?
They go
up
up pretty high. The
Yeah.
biggest thing to remember, guys, is I don't want to get into too many details and
Every
nuances.
county is different.
Every county is
Yeah,
different,
yeah.
but on top of that, once you hit 3 and 4-unit properties, the property, there's a thing called self-sustainability, and what FHA basically did is they kind of caught on and said, man, there are some people out here that are intentionally trying to go buy a 3 or 4-unit property with no intention on living in it, and that's not what FHA is intended for.
No,
it's intended
exactly.
for people buying a house, owner occupied, and if it's 3 or 4 units, the way you qualify, regardless of your income qualifications, the bank's going to say, hey, Mel, well, there's a 4-unit property. It's $1.5 million. You're only putting 3.5% down. God forbid something happens, but if you lose your job and you're no longer working, is this property self-sustainable
Yes.
just based on the rents? And if it's not, you're going to have to put more of a down payment.
And that's where your team comes in, right?
Absolutely.
We have done plenty of these in the past, right? So what that means is that your realtor has to be on top of their A game, right? They have to know investment properties. Maybe they're investors themselves like us, right? So meaning that when you're looking at these properties, your realtor and your lender need to be running something called a pro forma sheet to
Absolutely.
make sure the home actually qualifies to be self-sufficient, right? So they have to be knowledgeable of the area and the rents, right?
Absolutely.
They have to run it through that pro forma sheet so the math makes sense. And then you can go ahead and try to get into the home, place an offer and all this stuff, right? So your team matters. Absolutely.
100%. And again, you know, the beautiful thing with FHA is it allows you to get into your first home, owner occupied. It's the only way that program works. There's no second home, no investments. FHA's for owner occupied. But again, it gives you this, and you can buy multiple units with VA loans. Their guidelines are a little stricter as far as rents and all that stuff. But and conventional has it too, guys. But the main thing again with all these programs are there's so many amazing options available that allow buyers to not only qualify for single family homes, but possibly get into a duplex or a triplex or even a fourplex. Those are all considered a 1 to 4 unit residential. But it gives you the flexibility of maybe saying, I can't afford a house in this area on my own, but if I had a tenant that was covering partial of my rent, that could help out. And again, every situation is different, but that's why it's so important to kind of get some of these little nuggets and then talk to a couple professionals so that we can structure and build something that works specifically for you.
Yeah, it makes sure the realtor that you are selecting actually knows about investment properties and how to run a pro forma sheet. Super important. I cannot stress that enough. And trust me, after 18 years of doing this and teaching classes and doing all this stuff, not every realtor knows these things. They don't. They really don't.
Not every banker knows the back end rules either.
Okay.
And that's important. Absolutely.
Right. It's almost as, not every realtor knows. Let's just leave it
Absolutely.
at that. Okay,
There's
so
a
make
lot of
sure you
great-
interview them.
And
okay?
again, there's amazing bankers out there all over the place. There's amazing agents that we know and work with, colleagues, bankers that I work with that are smart, that have integrity. But again, the purpose of this information, guys, is to just give you some little cookies and bites.
Yep.
So you kind of know what to look for. Maybe write some questions or notes down so that when you're talking with your team, you get the right questions. Last loan out there, right, is your standard conventional loan. A conventional loan, you can go into houses with as little as 3% down on some programs. Typically, it's 5%. Conventional loans, they have mortgage insurance up to a 20% down payment.
Right.
The difference between like a VA and FHA versus conventional is conventional loans, their mortgage insurance, the interest rates, all that stuff, it's very, very FICO driven and specific. So kind of like I mentioned with FHA, that you have the ability, say, from a 660 to an 800 to get almost the exact same loan. On a conventional loan, 660 and 750, 800 is a completely different world. The rates are different. Your mortgage insurance premium's different. But again, it's amazing program. 5% down. Again, you do have options, put as little as 3%. And once you get 20% equity, that mortgage insurance falls off. But again, that's the beautiful thing, right? Is talking to your banker and sitting down and going over options, and never let anyone tell you this program is better than this one. Have them break things down for you, specific dollar and line by line, so that you can decide what's best for your family.
And Dave, quick question. So the PMI falls off, right? About how much should we save in there? An average.
It would just depend. Like someone that bought a house with 5% down, let's say it was 600 grand, and you're depending on your FICO score. I mean, let's say your PMI was anywhere between. If you got great credit with 5% down, you may get PMI that's 80, 90 bucks. Your credit's a little lower, but that's the loan you type to go with. It may be a few hundred. But again, that's a cool thing, right? I've had people that had a loan and they really wanted to go conventional on some specific product, and all of a sudden 250 bucks a month falls off that mortgage once they get that equity. There's easy ways to get it done. You can call your servicing company and all this stuff. It's really awesome. Another important tip to remember, guys, first-time home buyer is not necessarily like the solidified truth. And I only want to bring that up because you may be watching a video and saying, oh, well, I bought a house with the conventional loan, 3 years ago, and now, my family's grown, we've outgrown it. I got a new job that's, up the coast or something else, and I really want to buy a new home, but I already used up my first-time home buyer benefits. That's kind of a sales pitch. What the banks are referring to is your occupancy, meaning are you buying that house with the intention on living in it as your primary residence? We can get into that stuff down the road, but just know too that if you owned a home, or maybe you're selling one home and you're gonna sell one and at the same time it's called a contingent sell, buy another property, you still could take advantage of all these programs. So if you got a house on an FHA mortgage right now and you're selling that house, you go to Mel and Mel says, look, we can list your property, here's how much you make, we can close on that and you can buy this other home simultaneously, sell yours and then close on the next one.
Concurrently, we call it.
Let's say you have an FHA loan on the first house, you could use an FHA loan on the second house again. So that's another important thing to know, right? And again, that's where we come in, where you talk to, and again, not just us, but your banker, your agent, your team, which is what we like to always refer to ourselves as, is a team. And we can kind of explore those options and show you what works. So those are your 3 basic types of loans. They're all amazing in their own right. And, talking to somebody who understands all 3. If you're not a veteran, unfortunately, the VA loan, you don't have the ability to use it. If you are a widower of a veteran, you can take advantage of that VA product. But other than that, guys, that's 3 different loans. VA, FHA, conventional, they're great. They're usually the most common. Next week, we're going to get into like alternate types of financing for self-employed people, but those are your 3.
Yep. And then let's give him a little bit of some buyer tips, right? Because we were talking about how much the market has shifted.
Absolutely.
Right? And how much money, free money, our clients are starting to get. Obviously, you need a strong negotiator on
Absolutely,
your side, right?
Big difference there.
Yeah, I mean, I think Dave and I, we get pretty tough with the listing side, or the side selling the property, right? Because we understand how the market has shifted completely.
Absolutely.
It is a buyer's market now, right? Meaning that you have less competition out there. Not as many buyers as you used to have before.
Yep.
So what that means for you is you can get aggressive, especially with homes that have been sitting on the market 30, 40, 60 days, 60 plus days now.
Absolutely, yeah.
I mean, we're seeing some beautiful homes on the market at 75 days. What that means for you is we, as a team, we smell blood. It's blood in the water, okay?
Absolutely.
So we get super aggressive. Just to give you a quick example, VA client, he got what, 11,000?
11 grand.
11 grand, no, 12 grand total. 12 grand total. Was it 11?
11 plus,
it was
plus
11.
They paid for pest and all this other, so about $12,000.
Well, about $12,000 total,
Absolutely.
right? FHA currently
We
in
have one
escrow,
right now, yeah.
8,000 towards our closing costs.
Not a bad gig.
Right?
Not a bad gig.
And then obviously new construction, right?
Yeah.
Man, we crushed it there. A total of $84,000.
On one buyer. And these are all
Right.
recent transactions too, guys. So.
Yeah, within the last month and a half or so. Okay.
But again, that just comes down to one thing, is that it's important to have a team, right? Like you may get some people that and it's tough, but like if you're a buyer, guys, one important thing is, I know sometimes you're like, oh, well, I went and walked into this house and it's listed and I'm going to talk to the listing agent. Well,
yeah.
sometimes you have
No.
that happen, right? And now, even though these people are supposed to represent two sides, it's almost, to me, people can have their own opinions, right? And this isn't legal advice in any way, but when you got someone who's representing someone else and now they're trying to represent you, that seems a little hard, right?
It is very hard.
And you want a team. For me, I tell my clients all the time, I'm not here to be friends with everybody. I mean, there's times I'll call Melvin up and be like, what do you mean you didn't, this property over here, that one, like, it's late, I want to wait till tomorrow. Show this other one, like, and he'll go back to me the same thing. Hey, send him this scenario. Hey, what's call this other company that we found for insurance. Like, we're always holding ourselves accountable.
Yes.
And that accountability all comes down to one thing. It's fighting to make sure you get the best deal possible, right?
Yeah.
And sometimes we've had properties where a client is in love with the house, but the team on representing the other side, we don't like their approach on things, and we'll say move on. And all of a sudden, more often than not, you'll get a phone call a couple of days later. Hey, remember that offer that we told you guys we're never gonna take? Well, guess what? Now we're more than willing to take that.
Sometimes, like in dating, you gotta walk away, right?
Yeah.
You gotta walk away.
If it's meant to be, it'll come back.
It'll come back to you, right? And plenty of times, the deals do come back to you, right? As far as like dual representation, right? The way that we do it, that I do it in my team, that I'm gonna start implementing, right? It depends on the personality of the seller too, right?
Absolutely.
Because if it's my listing, my number one job is to represent that seller.
Yep.
It's going to be extremely hard to also represent the buyer, even though I'm very impartial, right? I'm really good at stepping away and keeping my emotions from deals, right? However, in order for me to represent that seller the best way possible, the honest truth, it's tough to represent the buyer at the same time, right?
You could be a great lawyer. You could be representing, the state, and someone else could be representing the accused.
Yeah.
And you can sit on either side and maybe argue your case, but you can't sit on one case and be like, hey, well,
you can't represent both
what about
sides.
this video from Mel? And on the other side, be like, sorry, Mel, I had to say this little piece on that side.
So the way that we're doing it in my team now is like, I'm representing my listing, right?
Yep.
But if we get that buyer, it goes to the next agent in my buyer agent in line to get that deal. And luckily in my team, we love to negotiate, right? So I'll let my agent know, you're gonna be going against me.
Yeah.
We're battling, right?
Absolutely.
I'm here to represent the seller. You better put your big boy pants. I'm coming for you.
Yeah.
Right? Because our job is to represent, the buyer and the seller, and we can only do so from an impartial point.
My job is to take care of my buyers.
Yeah.
First and foremost, financing times. you may get a listing agent that says, I don't like a VA loan. I don't like this. And I'm like, with Mel, it's like, send me when you put your offers out, CC me on those offers. I'll take care of that agent. Let me call him. Let me talk to him. Let me explain how this type of financing works. But again, guys, all circles back to the same exact thing, which is your team matters.
Yep.
And being educated matters, right? FHA loan versus conventional. Which one's better? I could look at someone's information in 20 seconds, tell you there's a better loan for you, but that is not my job. My job is to be an educator.
Yep.
And you know, that is what we pride ourselves on. And again, thanks so much for listening to us again today, guys. We got to hear a little bit about
some history on
little 16-year-old Johnny Walker working in his store shop and cooking some prime time in the back. You know, you got to kind of hear a little bit about different types of loan products, which are really cool. You even got a little nugget in there, right? On, hey, if I go walk into this listing and I'm not represented, like, is it a good deal? You never know. You may walk in and you may end up with a great deal, but something to keep in the back of your mind is exactly that. If it's just hard to represent two people to the best of your ability the same way.
So interview agents.
Yep.
Yeah, 100%.
I would tell people the same thing. Don't just come to me. I love when people talk to other bankers because, you know, if they have nothing to compare it to, then for me, I'm like, no, go talk to 4 or 5 people because when you come back, you're going to know the difference. Same thing with Mel. I've had people that say, Dave, do you have someone to recommend? I say, well, I do. But talk around, look around, and exactly that. When I tell Melvin, hey, I got a buyer, I want you to, you know, I'm going to give him your number to reach out. His thing is the same thing. Have you talked to any other agents? No.
Yeah.
And we make it a point to say, speak with some other people and get a feel for someone, right? Because that connection is also important. You want to be represented and you want your financing to be done by people that you connect with.
Yeah.
And trust is important, you know?
Yeah. Well, so this was really good.
I know. If I stick another sip, I'm going to start feeling it.
All right.
I haven't ate nothing yet
so
today.
Thank you guys for tuning in. I think the next episode we're going to be sipping on a beer, right?
Yeah, it's a good one.
So stay tuned to episode number 3. And Dave, I really appreciate this. This is really good. It is rich. I'm going to say rich, has a bite. True gentleman's drink. I like this.
A true gentleman's drink. There
Cheers.
you go, guys. From 2 gentlemen to ladies and gentlemen out there. Cheers. Be a clever homeowner.